Hello, everyone, and welcome to the Coinbase Markets Podcast. I am David Duong, the Global Head of Investment Research here at Coinbase. As always, I am joined by Colin Basco, who works with me in research. Colin, how are you doing?
Doing well. Prices are at a new low.
Yeah, I think we're going to get into that because, it's not like there's anything else to talk about right now. We are recording this a little later than usual. We're recording this on Wednesday because I had a conference to go to yesterday. It was on tokenization, so less or somewhat removed from the price action that we're seeing in the last few days. It's still a very prominent theme among our institutional clients, and it's interesting because I've been going to a few conferences. It seems to be conference season, and everyone I've kind of talked to has been saying, yeah, attendance has been weaker than it has been in years past. At this particular conference, and I guess I'll dox it. It was the Ondo conference. I think they're probably happy for me to promote it on the podcast. But I was talking to Ian, and they were telling me that they're actually getting more attendees than usual. In part because I think that institutional investors are really kind of leaning into stablecoins, really leaning into tokenization. But I think that for the rest of the complex, it's been more difficult. And we're going to talk about it because I think this has been the big issue. We saw crypto experience a very sharp decline over the last few days. We really saw it happen over the weekend. My take on it is I think that gold prices fell, and this isn't a big surprise. I'll put the chart up if you're watching on YouTube or watching on Twitter. And you can kind of see that, I think a lot of people probably saw gold as a last narrative standing, or more specifically, they thought that gold to Bitcoin rotation would kind of support levels here. And instead, we saw the nomination of Kevin Warsh to Fed chair to probably begin in May. And because he's been fairly anti-QE in the past, I think people were more concerned about some of his kind of hawkish leanings in the past, notably during the global financial crisis. That brought gold and silver sharply lower. We could see it like on Coinbase, for example, we have gold and silver futures, and that's where all the volumes were. Not all the volumes. I mean, I'm definitely exaggerating, but a lot of the volumes were on our platform. I think as a result, we saw Bitcoin, instead of trying to recapture some better levels, started kind of weakening alongside of that. Colin, am I missing anything?
No, I mean, we wrote about this as well, like whether or not the pullback in gold would actually receive a bid for Bitcoin, but clearly not really seeing that. We also put out in our last week's report a new quant model that went really in depth to mathematically disprove the gold to Bitcoin rotation myth. So I won't really go in depth again since we already discussed this in detail in the podcast last week. But if anyone is interested, you can check out either one of our X handles, which has the full report with the full quant model. But yeah, I mean, that's exactly what we saw, right? We saw the full pullback in gold. Pretty much none of that went into Bitcoin. So clearly the rotation is not really occurring right now.
Yeah. And as we speak, we saw gold really kind of weaken for about 2 business days now. It kind of picked back up. I mean, to be fair, I think that precious metals tend to weaken over the course of February. There's a seasonal bias against it. So this feels kind of like a dead cat bounce. It's hard to say. But just Bitcoin, man, it's been you can kind of see the chart if you're looking on screen, but it just keeps kind of trending lower. We saw this over Asia's trading session, it traded sideways for most of it. But now I think if we're looking at what's going on in derivatives, it's really, really telling. For example, in options, I tend to look at the put call skew to kind of just get a sense of how people are positioned. Are they being positioned defensively, for example, if you're seeing the puts kind of rising over calls? And if anything, it was weird because you saw both Bitcoin and ETH, the put call skew actually soften a little bit, but implied vols still very elevated. But normally, if you looked at that, you'd be like, oh, okay, maybe there's a reversal at play here. And that's not the case. If you're looking at just notional volume on Deribit, for example, over the last, say, 24 hours, 75% of this is being executed via bear put spreads. So i.e., if I need to translate that for anyone who's not into options, effectively option traders are not just looking for protection anymore. They're now actively positioning for a downside move within this range. So it's been crazy. I mean, like I said, I was at a conference just yesterday. We had a client dinner with some of our institutional clients last week. And I mean, the big question is like, well, who's the marginal buyer out there right now? Like, who actually wants this? Because in the past, 70% of the Bitcoin or crypto moves were dominated by retail. And now, like I was at a conference, I think I spoke about this like last week in Miami, more who are retail and high net worth aligned. And a lot of them are like, yeah, this is a place where like as long-term holders, they're a lot less certain about what the price action is going to be and whether like this is something that they want to hold and give to their kids and give to their grandkids. And it's tough, like I feel like we're grasping for straws. Like I think Colin, you brought up to me that like you saw online and people were talking this ISM theory about how like if ISM like goes higher, the U.S. economy does better. Like that should also be supportive for Bitcoin. I don't know. Is that invalidated yet? Like, are still people still talking about that? I haven't been paying attention.
Yeah, I saw that being floated by a couple of different big X accounts. And it's just, once again, the same problem of sample size errors. I think people are just trying to find any correlation that they can justify to say that Bitcoin is going to appreciate over the long term. And when people's thesis get invalidated, they just continue to expand the horizon so that maybe they'll eventually be right over the longer period of time. But I don't think there's any real statistical basis for saying that the ISM index, coming up positively should affect Bitcoin positively. Clearly it didn't. It came out today with the data. ISM came in better than expected, and Bitcoin is at 73.5K right now. So not really a great showing in terms of that narrative, but I mean, I don't know. People are just floating all sorts of narratives every day now, it seems like, to justify Bitcoin going back up. But I think the real test is going to be actually reforming structure and seeing a breakout. And that would be like the more reasonable way to trade this. I don't think trying to identify support from here is going to be easy, just given the fact that Bitcoin has been essentially in free fall ever since it lost that 88 to 90K region that we sort of tagged as like a really key level that needed to hold. Otherwise, the probability of a new local low being made would increase significantly. And that's exactly what we saw. So from here, I think we just need to wait to see actual structure being formed. And again, that brings up the question of who the marginal buyer is going to be.
Yeah. I feel like we constantly do a PSA on this podcast. I'm sure our listeners probably hate it, but I feel like it's necessary because we've talked about this for the 4-year cycle. We've talked about this for like the gold Bitcoin trend. I mean, like people love to extrapolate, and I get it. Narratives are seductive. They're easier to kind of grasp than just kind of looking at raw numbers. But when you pick like a statistically unsound kind of approach where you're just like, this happened the last 6 times, and we got to be like, yes, 6 times is not a lot. That's not statistically significant. Or 4-year cycles, it's like we've had 4 that we can kind of count on. It's like that's just not enough data. I mean, like I hate kind of pushing back on that kind of stuff, but like you see it all over Twitter. And again, I get it from a psychological perspective. It's simple, it's easy to grasp. People like looking at it. But when you see a chart and like 2 things are trending the same way, that doesn't necessarily mean they have a relationship. Like, or rather, let me put that a different way. They might have a relationship, but doesn't necessarily need to be a strong relationship. And once again, correlation does not equal causation. Anyway, you have pointed out a lot of times, though, about the DCA strategy and what the right DCA strategy. You just said it just now. Could you just take it through one more time, but not for the last time?
Yeah, so DCA, for people that don't know, is dollar cost averaging. And that essentially means that if you want to get exposure to an asset that you believe really strongly has long fundamental growth perspective, then what you can do is you can allocate a certain amount of dollars every day to spend on that asset and accumulate over time. And the idea is that over time, you'll generally be able to get a good cost basis in your buys because you'll be able to DCA both the uptrend as well as the downtrend. Now, what we've seen in practice with assets that are dominated by momentum is that they have really sharp moves up, and they also have really long periods of consolidation where volatility compresses, and that sort of serves like kind of a coiled spring that generates energy for that up move in the future. And Bitcoin exhibits that kind of behavior. And if you play out the math over thousands of trades, you can see that a trend aware variant where you simply buy when Bitcoin is above a very basic moving average of like, say, 50, for example, and then accumulated cash on the downtrends when it's trending down, and then lump sum investing all of that accumulated cash as soon as it once again resumes trending, you'd be significantly better over the long term than just average, you're just, normal DCA investor. And then you also see other sort of acquisition strategies like the DATS is one example where they try to accumulate additional exposure to the asset over time. Sometimes they issue equity to be able to finance that purchase of those acquisition of those assets. So like something that has also been trending on X is where exactly is the cost basis for, strategy as an example, since they're the biggest Bitcoin DAT. Currently it's around 76,052 based on their own website. And the reason for that, some people are kind of confused, like why are they, why is price under their cost basis? Well, the thing is that generally when MNAVs, which is the market to net asset value of these digital asset treasury companies, when it expands a lot, that means that they can issue equity and be able to purchase, Bitcoin more easily. And generally, if you look at price compared to MNAV, what tends to happen is that MNAVs expand when price is trending really strongly in a bullish environment because euphoria tends to run away and get people really hyped about an asset. And that can cause valuations of the asset to expand significantly. And you can see large divergences between, the trend line support of these assets and the actual price of the asset itself. And what this means is that when MNAVs are super expanded and allows the DATs to be able to buy additional Bitcoin, and that price that they're going to be acquiring Bitcoin, though, once they sell those shares is going to be naturally higher because once again, it's when the asset is trending so high. So that's the kind of issue where you end up in a situation where you're buying Bitcoin at a premium. And as a result, you can end up with a cost basis that may be higher than what you would have expected.
So I like that a lot because I think, we've gone through the DAT situation multiple times now. And I think that, it's not a surprise. This happens in traditional finance as well. Like, you might not always get the price you want because the inflows of like when you actually get funding might differ from that. I have friends who have started hedge funds, and this is the quintessential problem to kind of get off the ground. But then really, this kind of brings us to the big question then, like, well, what's the demand driver to kind of get us to break out here? Like, I don't even care if we break out, honestly. Like, what is the demand driver to get us to stabilize prices here? And that's a loaded question. Like, I don't even think I have the answer, but Colin, I'd love to kind of get your take. And I'm happy to kind of volunteer my own as well.
So some people were speculating that digital asset treasuries would be that marginal demand driver. Problem becomes when MNAVs are really low. I think the magnitude at which they can be a marginal buyer begins to dwindle the lower the prices get, which means the additional demand that they can offer to the market also goes down. So as a consequence, that demand problem becomes larger. So I think that's the real issue. I don't think they're going to be a forced seller. So I know a lot of people have been sort of, floating that theory on X. That's not the case in my opinion. So they've essentially built their capital stack, at least strategy definitely has built their capital stacks so that there's not going to be a significant chance of margin calls no matter how low Bitcoin gets. They don't have any Bitcoin collateralized loans anymore. There's no covenant triggers that are tied to the price of Bitcoin. The one structure that may have been able to force sales in prior cycles was their collateralized loan with Bitcoin, but that's gone now. So today their Bitcoin is pretty much unencumbered, and their largest funding sources are primarily unsecured convertibles with long dated maturities and perpetual preferreds with no maturity. So even if Bitcoin trades well below 76K, that's not really going to create any large chance, or at least a higher probability of any liquidation event. It only just creates unrealized losses. The problem is more on the demand side, in my opinion. It just affects their ability to raise more capital to be a sustained marginal buyer the lower the prices go, meaning that I think the lower we go, the lower the likelihood that they can be a huge marginal buyer in the market to try and drive, a breakout. So I think from here, the real question is going to be, who are the marginal buyers other than digital asset treasuries that can enter the market? Is it going to be like hedge funds, institutions, et cetera? Could there be a big liquidity sleeve that starts a momentum play? I think a lot of that is questionable, and it's really hard to see a macroeconomic catalyst at the moment.
Yeah, I completely agree. I think that this is the tough part. We're looking for a catalyst in the crypto side. I'll be honest, I thought that some of this would come from the geopolitical kind of macro developments that we've been seeing. Obviously, dollar debasement has been a pretty big concern in this cycle, and I think that that might have kickstarted some of the move that we saw in gold. But definitely over the last 3 to 6 months, I mean, gold has been a pure momentum play, and I've said this on the podcast. I've been saying this for probably a few weeks now, it feels like, but definitely I think that the evidence of Warsh driving gold prices sharply lower and silver, of course, as well, I think was definitely evidence that this is why Bitcoin hasn't necessarily caught up with gold. If it was a pure debasing play, then I think that that absolutely would have been the case, but it's not. Like, it's a momentum play, and we're kind of seeing that again, like, play out over like the last 2 days or so in gold, and this is why I think Bitcoin can't catch a break. I mean, a big part of the breakdown we saw on 1010, and who knows what really kind of triggered it. Like, because ostensibly it was the announcement from Trump about tariffs on China, but really it was a confluence of things as well, because some people were concerned about the 4-year cycle kind of peaking around that time. We saw on October 9th, 2025, that MSCI was talking about removing MicroStrategy from their indices. So I feel like there were things that kind of got conflated with just kind of one single issue, because it's easier to kind of accept the narrative that way rather than kind of try to break it down and say, like, well, there are these market structure issues, technical concerns. And I really think that's kind of where it kind of comes down to. But as far as other potential catalysts, the other thing that we've been looking at is what's going to happen with the market structure bill. And I think that there have been a few developments. One of the things I think could be meaningful is what is happening on the regulatory side. Obviously, a lot of people have perhaps not forgotten about it, but have kind of been paying more attention to the price action than what's actually happening on Capitol Hill. Last week, we saw a pretty meaningful development. The Senate Ag Committee actually advanced its version of the bill on January 29th. I think that was Thursday. It was a 12-11 vote, but it was a huge kind of development because this is the first time we saw a comprehensive crypto market structure bill actually clearing a Senate committee. Pretty important provisions in here, very similar to what we saw with the Clarity Bill passed by the House in 2025. This would grant the CFTC expanded authority over spot crypto markets, which would then be classified as digital commodities. Also, a very important development happened just yesterday, because we saw that the White House, Trump's crypto advisor, Patrick Witt, actually bring together a group of crypto firms and banking groups to actually compromise and talk about some of the impediments that have kind of stalled the bill. This would, of course, include like the stablecoin yield, things like that. So I think that if you were looking at what's been happening, like, this is a chart on Kalshi, for example, prediction markets, that are showing that there's been a massive uptick of people whose expectations were fairly low about something getting done in 2026. And that has kind of flipped. Now, like 74% of people believe that something could actually get done before May. So some pretty meaningful developments. Colin, anything else you want to add there?
Yeah, I think my main question is it going to be a big enough catalyst anyways to break Bitcoin out of this downtrend? So I think that's my primary concern as a Bitcoin investor. So, like, is this actually going to have a large impact on pricing? And I don't know, to be honest. I'm pretty agnostic to price catalysts. Generally, I just trade the reaction rather than trying to speculate on what the reaction could be. So if the way that I would play it is, if Bitcoin forms structure and then, the bill may or may not pass at some point in time, and if that correlates with the key break of structure and causes like an actual significant breakout on statistically significant volume, then I'd say it's like an impactful thing and could be a driver for a shift in regime. But if not, then, I mean, there's a lot of noise in markets. So who knows how much is actually priced in already or not priced in. Seems like from the poly market odds, is 74%. That's may or may not be priced in. And if it is priced in, then clearly not many people seem to care about whether or not this is going to actually affect Bitcoin positively. And to be honest, I'm like a price action first kind of guy. So if Bitcoin can resume a bull trend, then everything else in crypto looks attractive to me. If not, then everything else in crypto, no matter how strong the fundamental catalyst, doesn't look super attractive. I'll give you a good example of this. Like there is a pretty strong fundamental catalyst for like Uniswap as an example, like their fee switch changes. And you saw that entire move get retraced within the week. So I think those types of situations are likely when Bitcoin is in a bear trend. So anything that can get us shocked out of the bear trend is what I would be looking for.
Yeah, I have no edge on this, but I'm looking at the Kalshi markets right now, and again, if you're watching this online, you can kind of see like the chart that I'm showing, but like it was a huge kind of shift because previously like the odds were sub 25% that we would see a market structure before May. Now it's currently at 74% as we're recording this. So, you know, I do think that it could represent an important catalyst for the markets, even if it's a little uncertain which sectors, how it's going to kind of manifest itself. But Colin, before we go, let's talk about key levels, because I think this is going to be like the thing to watch in terms of technical developments and other things that are going to be moving things over the next few days. What are you seeing?
Yeah, so from here, I think the first key level that I see is primarily the 81 to 82K range, just based on where the most recent high volume pivot points lie in market structure. So for anyone who doesn't really know what a pivot point is, just real quick, it's where you see either a local minima or a maxima in price, and volume can help you filter how meaningful that inflection point actually was. And what makes some levels especially important is when you see a lot of pivots overlapping in the same price zone, and those pivots forming on high volume. So that combination is basically the market voting on a price level multiple times with real size behind the decision. So each of these high volume pivot points essentially is evidence that a large amount of business and transactions was transacted here, which means that you get positions being built there, they're defended, they're potentially trap traders there. And when price is revisiting that zone, it's an actually significant area of where the market has determined whether or not price is trading at a premium or at a discount. And as a result, that tends to create a lot of liquidity, a lot of resting orders there. You'll get stronger reactions. You'll have buyers that are defending it before and wanting to defend it again. You'll get sellers who got rejected there looking to reshort. Anyone stuck there, trying to get out at break even. And whenever you see a lot of those cluster of high volume pivots, it's essentially a level where the market cares. And that is why sort of those zones become really important from a decision point perspective for trading, because a lot of volatility can compress there. You'll either get a decisive break and continuation, or you can get a rejection and people buying support or rejecting and shorting an area of premium. So specifically in crypto, in my opinion, I think they hold unique weight over other asset classes, primarily because it's very difficult to value crypto from like a purely fundamental lens based off of cash flow or estimated growth rates of that cash flow, et cetera. So like what people tend to do in TradFi doesn't necessarily apply in valuing crypto. Instead, in my opinion, it's a highly momentum-driven asset class where metrics that identify primarily supply and demand are very helpful, in my opinion. So that sort of frames like where exactly we're like the sort of methodology behind identifying these key levels. And sort of going a step further in my own model backtest, trading breakouts tends to have a significantly higher win rate than trying to essentially blindly buy support on faith. And the reason why I think the probabilities differ so greatly between these two strategies is because a breakout or a breakdown, that implicitly is implying that there's some sort of active repricing of that previously established area of premium or discount. So the key word here is repricing, right? It's an active form of repricing, which means not mean reverting behavior. So when price is range bound, the dominant behavior tends to be mean reversion, which is where you get that famous saying of buy low and sell high. But once a breakout is accepted, the market actually shifts to trend behavior, where participants are starting to think, is this cheap or expensive within the range? And now they're starting to think, now we're in a new regime, new reference point. And this is where you get active repricing, active rechanging of what people consider to be premium or discount. And that's when you get the trend behavior. And that's exactly what we just saw, right? So we saw that break of 88 to 90K, and then we're seeing a downtrend, right? Now we're seeing a new shift in behavior. And that's where we go into that free fall sort of momentum play where we're getting a lot of liquidations, we're getting long liquidations, and no real structure forming right now. So like if you were to invert the chart, you would be like, oh, wow, we're going into bull breakout, right? But reality, what we're doing here is the inverse. We're doing a breakdown. So that's where it's really difficult to sort of buy support, because as you know, the common saying is never short a trend, never go against the trend. This is the same thing, buying the downtrend, right? So that's where it becomes difficult. So buying support here is essentially you're betting on inertia, which is disproven, right? Because now we're trending in the opposite direction. So that's where I think from the key level perspective, support can hold for many reasons, right? You're essentially, without confirmation, you're paying for the story rather than buying evidence of a new repricing. So it's like sort of a passive way of investing, which is why I think support oftenly fails. And why once we lost like that 82K region, which previously would have been what you would have considered as strong support to hold, we actually lost 82K without even a retest, right? So we essentially just knife fell right through 82K. So as a consequence, now we're around 73K. Now the question then becomes like, are there any key levels from here? My argument would be that while there are support levels that could theoretically hold, it's more of a form of like passive investing that has a lower probability of ending up profitable until structure reforms, or if you would get a breakout above 82K. So like the main level that I'm currently looking at would be 82K instead of levels lower. My primary case would be if we can see a strong reclaim of 82K, then I think the probability of further upside increases rather significantly. But on the downside, it really does look pretty gnarly. It's tough to say from a key level perspective if I would be a buyer at any of those levels until I saw structure reform and a potential breakout.
So your strategy is more systematic. I should like just kind of translate for our listeners, because what you're looking for isn't to kind of find and buy a low to kind of hold long term. If you're a long term investor, like this is not the approach you'd be taking, but rather you're looking for the turnaround. Once it kind of breaches above 82 again, then you'd be a buyer up there. I think that there are long term holders who are trying to basically find the level that makes sense right now for a long-term buy, i.e. if you're holding for 12 months to 3 years, for example, and that's a bit different right now. And I think that's a bit of a tougher kind of premise at this point. It seems to be a much more technically driven market at the moment. But hopefully that will help some of our listeners out there. Thanks so much for listening. Really helps when you like and subscribe. And, you know, you could always reach out to myself or Colin on Twitter. Tell us what you're interested in. Tell us what you want to hear. And maybe you'll hear it on the next podcast. But with that, we're going to try to keep it a little bit shorter today. Thank you so much for listening, and we'll see you next time.
All statements and analysis correspond to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Prior results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third party investment strategies or digital assets or any website or content related thereto.